this video, we're going to get into the basics of bond financing. A bond is a loan in the most simple of terms. When you buy a bond, you owe the loaned money at the end of the loan and you're going to be paying interest along the way. The par value of the bond is the principal amount that you owe at that bond's maturity. Typically, you are paying semi-annual interest payments for that bond. A company can choose to finance with bonds for three main advantages. First, bonds don't mean ownership. So when you buy a bond, you are lending money to that company. You are not owning a part of it. Second advantage, the interest on bonds is tax deductible, and your return on equity can increase with bonds. But I'm enunciating can because it can also decrease your return on equity if the bond is not helping the company make a higher income. The interest expense they have to pay slashes net income, and return on equity depends on net income. So bonds can decrease return on equity. And the biggest disadvantage is that you have to pay periodic interest payments and par value at maturity date, regardless of cash flows and income for that company. The bondholder and the issuer are going to formalize the issuance of this bond in a legal contract known as a bond indenture. So if you issue a bond at par value, this is going to be known as a par bond. Your journal entry will look like a debit to cash and credit to bonds payable. Interest expense will typically be paid semi-annually, and for the sake of our examples, we are going to assume that you are paying twice a year. Contract rate is written in the bond contract, and we use this to calculate cash interest payment. So contract rate multiplied by the par value and divided by 2 is the bond interest expense for that half year. And you are paying that interest with cash, so credit accordingly. At the maturity date, you will debit bonds payable and credit cash for the par value. The market rate of a bond is the going rate that borrowers are willing to pay and lenders are willing to accept for the risk of that bond. This rate will determine the price of the bond. If contract rate and market rate are equal, then the bond is sold at par value. If the contract rate is lower than the market value, then the bond's price is going to be discounted. On the other hand, the bond will sell at a premium when the contract rate exceeds the market rate. If a bond is sold at a discount, then the issuer is going to be receiving less cash at the issuance of the bond than they have to pay at maturity. So the discount is subtracted from your par value to get your carrying book value for those bonds. The journal for this goes as follows. So credit your bonds payable by the par value, and then you would debit cash by your carrying book value. Because you are selling at a discount, cash will be less, and the difference will be recorded with the debit to discount on bonds payable. This is a contra liability account, so it's going to have a normal debit balance. If a bond is issued at a discount or a premium, we don't just leave that amount sitting on the books forever. We are going to move it into our interest expense over the life of the bond, and that process is known as bond amortization. For our examples, we are going to use the straight line bond amortization method. You will take the total discount or premium and divide it evenly over the number of interest periods. That gives you the amount you amortize each period. Since the discount is a contra liability that we want to go away over time, we are going to credit the discount to reduce it. In a journal entry, we would debit interest expense, credit the actual cash we used to pay the interest, and credit our contra liability for the amortized amount. Now, if the opposite were to happen, we sold the bonds at a premium, we debit cash for the amount received, credit bonds payable by the par value, and credit our premium. Amortizing a premium bond will have you doing the opposite of a discount. You will debit interest expense and credit cash, but debit the premium on bonds to slowly reduce that balance over time. Whether the bond was issued at a premium or a discount, the carrying value is going to get closer to the par value as you near the maturity date. Once the bond has matured, the company will pay back the par value. This retirement is recorded as a debit to bonds payable and a credit to cash for par value. The discount and the premium should already be fully amortized by the maturity, so their balances are going to be zero. If the company chooses to retire the bond before maturity, they need to remove the bonds from their books, and the difference between carrying value and the cash paid to retire the bonds is recorded as a gain or loss. To find the carrying value, your unamortized discount would be subtracted from the par value, or your unamortized premium would be added to the par value. Now you would compare the carrying value to the cash you paid to retire the bond. If you paid more than the carrying value, this is a loss and debited as loss on bond retirement. If the cash you paid to retire is less than carrying value, this is a gain that we record with a credit to gain on bonds retirement. An installment note has you paying interest and principal of the loan both over time, not just all at the maturity date. So each payment would look like a debit to interest expense and notes payable for the portion of the principal paid, and a credit to cash for the total sum. Mortgages are an example of an installment note. If the borrower defaults on the long-term note for that property, the lender can take away the asset. That brings us to something called a secured bond. This bond is backed by assets, so bondholders can collect these assets as collateral if the borrower fails to pay. Unsecured bonds rely on the borrower's creditworthiness and are a lot riskier because there is no collateral. Term bonds means that those bonds will entirely mature on one date. Serial bonds will mature in portions at different dates over time. To reduce risk for a bondholder, a company will have to set aside cash periodically to retire bonds later, or what is known as a sinking fund bond. Registered bonds will be recorded in the owner's names and they are directly receiving those interest payments. Bearer bonds means whoever holds the bond physically gets the interest payments. Coupon bonds have detachable coupons on those bonds, so the bondholder can submit those coupons to receive interest. A convertible bond enables a bondholder to convert their bonds into stock. Callable bonds enable the issuer to pay off the bond early at a set call price. Now we are going to find our debt to equity ratio to see how much the company is financed by debt in comparison to invested capital. It's calculated as total liabilities over total equity. A higher ratio shows that the company is using more debt to finance its company, and this isn't necessarily bad, but it can be riskier. And now you can go down below to use my free downloadable study guide and free practice worksheet to review all this material, and give this video a like and subscribe.